Welcome along to this month's Compliance Corner webinar. My name is Samantha Peacock. I'm the Business Development Manager here at Landmark, with my main focus being on compliance for estate agents. And today we're going to have a recap of the money laundering regulations and look at the guidance provided by HMRC. We're going to do a quick overview of the risks posed by money laundering to your business and how you might identify these risks. And we're going to look at what HMRC advise and then look at three common areas of non-compliance, which is the risk assessments, dealing with foreign nationals, and identifying beneficial owners. This webinar is recorded and it shall be sent out to all of you that have registered afterwards so that you can share it with colleagues or use it as part of your staff training on the regulations. You are all on mute as well, just to prevent background noise, but my details will be on the last slide should you have any questions about either what was discussed today or our compliance system. So without further ado, let's get started. So the first place I want to start is just to quickly revisit the reasoning behind the compliance activity that agents undertake in relation to the money laundering regulations. HMRC, who regulate the AML compliance for estate agents, have released guidance which outlines their expectations. So although there is an acknowledgement from HMRC that estate agents do not handle any of the funds used to buy property, you are, in HMRC's words, a key facilitator in a property sale and come into contact with both parties to the transaction at an early stage. And so you are in an ideal position to identify suspicious activity. The intended aim of the regulations is to prevent the use of illegally obtained funds or terrorist financing from being legitimised through the sale and purchase of property. In terms of sources of money laundering, there is somewhere in the region of 100 billion laundered through the UK every year, so it's obviously not exactly small amounts. In the National Risk Assessment of Money Laundering and Terrorist Financing 2017 report published by the government, 27% of money laundering cases involved property transactions, highlighted the presence of companies and trusts. 36% highlighted attempted use of professional intermediaries, and 17% reported high cash payments. The recurring themes identified from suspicious activity reports, or SARS as they might be more commonly known, were unusual transactions relating to the same property in rapid succession, often involving in the use of cash or third-party intermediaries, and the use of companies or overseas trusts to conceal property ownership. And this scrutiny isn't going away anytime soon. Regulated entities, including estate agents, are required to submit a suspicious activity report where there is any suspicion of money laundering. In its 2018 annual report, the National Crime Agency, who are responsible for policing the UK's anti-money laundering regime, reported that of the 463,938 SARS that were submitted from April 2017 to March 2018, just 710 of those came from estate agents. And it's still even less than 1%, even if you include solicitors. So against the context of around 1.2 million transactions in the same period, you can see why HMRC are placing such a focus on property. You might have come across the government's latest AML awareness initiative, which is the Flag It Up campaign, and this highlights the legal and moral responsibility to those in front line of the UK property market have to be vigilant to money laundering. HMRC are clear that the best way to do this is to better understand the transaction and the individuals involved, also known as Know Your Customer, or KYC for short. In 99% of cases, this is likely to be self-evident, with people relocating, upsizing, downsizing, and so on, but you need to be vigilant where there is ambiguity over the purpose of the transaction. So in terms of the common areas of non-compliance, the first area of non-compliance we're going to focus on today is demonstrating to HMRC that you are taking a risk-based approach to money laundering risk in your business, looking at how you arrive at that decision to identify an individual or transaction as low, medium, or high risk. Now, this is where your AML risk assessment comes in. This is a critical document outlining the steps your own business takes to better understand the individual or individuals involved and the nature of the transaction in order to make an assessment about any risk. HMRC expect you to be able to present your risk assessment to them upon inspection. So what do HMRC say? Well, the guidance suggests that your risk assessment should be reflective of your customer demographic, the type of stock that you deal with, the services you supply, for example, property finding service, auctions and sales, financing methods, and your business geographic. Your risk assessment should demonstrate a risk-based approach, balancing the cost to your business and customers with a realistic assessment of the risk that criminals may exploit that business for money laundering and terrorist financing. This is allowing you then to focus your efforts on the most important areas and reduce unnecessary burdens. For example, a London agent may take a stricter approach than an agent in a provincial market town. Be aware of hidden risks. For example, a client of ours in the Lake District was inspected because of the number of high-value second homes in their area, which are often cash purchases. There are no hard and fast rules. It's about understanding your customers and your transactions better. Here is a list of characteristics that could point to a higher risk of money laundering. Now, it's not definitive, but it gives you an idea of things to be aware of. If this list is difficult to read, you can contact me afterwards for a copy of this. It's important that your staff are trained to be on the lookout for these sorts of characteristics and flag it with your money laundering reporting officer when there is any suspicion. On a practical level, it might be useful to think about your risk assessment in similar terms to your health and safety assessment. You assess a risk to the business, consider ways to mitigate the likelihood of it happening, and put control measures in place to protect your business. You should include what steps you and your staff take to decide on what level of risk is posed. Now, obviously, this will differ for vendors and purchasers, but broadly, you might consider whether have you met the client? Are they a UK national? Do they reside in the UK? Is the transaction high value? Is there significant cash involved? Is the transaction being conducted via a third party? Is the individual a politically exposed person or PEP? And what level of ID are they able to provide? Looking at these factors and then assessing how these might assess the risk profile of your client and or your transaction. In a previous webinar, we talked about how to write a risk assessment. The link for that is here, and it is on our YouTube channel, which has all of our webinars recorded on there. But with regards to your risk assessment, you should assess and keep under regular review the risks, including those posed by your customers and counterparties, and any underlying beneficial owners, services or transactions, financing methods, delivery channels, for example, like non-face-to-face services, geographical areas of operation, including sending money to, from, or through high-risk third countries, or, for example, countries identified by the EU or Financial Action Task Force as having deficient systems to prevent money laundering or terrorist financing. And you should also take note of information on risk and emerging trends from sources including the National Risk Assessment and HMRC's risk assessment, and amend your procedures as necessary. At all times, it's important to remember that your objective is to prevent illegal funds from being legitimised through a property transaction. Taking a risk-based approach gives you the flexibility to take into account the commercial realities to selling property. If, for example, your client is unable to provide photo ID, but sufficiently satisfies the requirement to evidence a private individual's name, date of birth, and residential address, then there's no need to be dogmatic about providing photo ID and delay the transaction. Similarly, if you are using electronic ID, you don't always need a pass in all cases. You may identify in your risk assessment where the checks do not pass, but you obtain additional paper evidence and file that alongside the electronic check rather than redo a check and potentially spending more money. Your risk assessment should also take into account your process for dealing with foreign nationals and non-UK residents. Statistics from the recent Property Mark National Conference laid bare to the risk to agents. 91,428 land titles are held by overseas companies. 170 billion worth of property is held by 30,000 companies or trusts based in tax havens. Foreign nationals and non-UK residents fall into two broad categories: those who are resident in the UK and those who aren't. Typically, due diligence on foreign nationals resident in the UK is broadly similar to UK nationals living in the UK. For example, an Eastern European family settling in the UK. In such cases, it is likely that customer due diligence can be applied. This is unless other factors in the transaction arouse suspicion. Where a higher risk is identified, for example, like significant cash payments, unusually large or complex transactions, properties bought through multiple companies to hide assets, and so on. In such cases, your risk assessment should identify that enhanced due diligence is undertaken. Where you encounter an overseas vendor or purchaser, or have an existing overseas landlord who decides to sell their property, this is where things can get trickier. HMRC outline that you should be obtaining the same types of documents for non-UK residents as well as UK residents. Your risk assessment will identify the risk. Where a low, medium risk client is identified, customer due diligence can be applied. Typical examples are where you have an existing client you've met and you have a pre-existing relationship with them. You can cite that in your risk assessment. As long as you have a record of the due diligence where your relationship started and nothing else has changed, it is likely your client risk will be low to normal risk, and you can complete customer due diligence in line with your procedures. Or what about a member of the non-resident landlord scheme? A non-resident landlord is someone who owns a rental property but spends more than 6 months of the year living outside the UK. Under the scheme, a landlord can have a UK tax residence, but the usual place of abode is in another country. Non-resident landlords are registered with HMRC, which may be used to evidence a lower risk when it comes to applying due diligence. Where new clients are resident overseas and cannot be seen face-to-face, enhanced due diligence must be undertaken. How this differs from your standard customer due diligence should be outlined in your risk assessment and AML policy. Typically, enhanced due diligence will involve verifying the identity of the individual you are dealing with, as you would with client due diligence, verifying an accompanying photo ID document. This may involve the client providing their identity documents to a recognised independent professional, such as a bank or financial institution, lawyer or notary for authentication. They must forward the authentication statement and copies of the ID document onto you. Or they could look at verifying the validity of the documentation electronically. It may be your policy to implement additional checks, such as confirming ownership details of the property with Land Registry, taking steps to verify the source of funds, or ensure any payments are made through a bank account with the same name as the seller or purchaser. Now, this list is not exhaustive, but they are indicative steps that can be taken. As with all compliance activity, it is important to establish a process, have your staff trained, and evidence your activity. The final common area of non-compliance for estate agents today is identifying beneficial owners. Customer due diligence requires you to take a rounded approach to the transaction and really understand your customer and their motivations. And this is also known as Know Your Customer that we talked about earlier. So when it comes to customer due diligence, you need to be identifying any beneficiaries to the transaction, otherwise known as beneficial owners, as well as purchasers that have had their offer accepted, as when you deal with an occasional transaction which involves €15,000 or more. In a standard transaction, you need to ensure you are confirming who owns the property for sale. In most cases, this is reasonably straightforward and is going to be the vendor or vendors. There may be instances, however, where you feel the need to undertake your own verification, where the nature of the transaction poses a higher risk. You may, for example, choose to undertake your own verification in cases where you are selling on behalf of a landlord, with a higher risk being posed by an absent landlord. Divorce and distress sales may pose a higher risk, along with properties which have been changed hands a number of times in a short space of time. These are just examples, and your own experience and risk assessments will inform your decision to undertake additional verification. So how do we check who the owners of a property are? Well, fortunately in England and Wales this is reasonably straightforward. Most property in England and Wales is registered with Land Registry, and you can use the title held by Land Registry to verify the information you've been provided, which corresponds to the information held on the title. Now, the title is split into 3 sections, A, B, and C. Proprietorship information is held in section B and will identify the owner or owners of the property. You must complete your customer due diligence on all owners of the property. The title also holds information about the property that might be considered material information in the context of consumer protection regulations. Section A contains a description of the property and whether it's freehold or leasehold. It'll refer to a plan, and a copy can be obtained from the Land Registry. If the property is leasehold, there'll be brief details of the lease, such as the date, the term, original parties, and things like that. And a copy of the lease, again, can also be obtained from the Land Registry. Now, if applicable, Section A will also detail any rights, agreements, or matters benefiting the property, such as rights of way or a declaration about the boundaries. These might be set out in full or by reference to an earlier title document. If the latter, a copy is usually filed at the Land Registry and can be requested. Now, although it's not expected of agents to further investigate any rights or restrictions, you may wish to ask your vendor for further clarification or advise buyers to inquire with their solicitor so as to ensure that nothing comes out of the woodwork 4, 6, 8 weeks down the line that causes the transaction to fall through. By taking a proactive approach to compliance, not only do you demonstrate you've considered who the beneficial owners are, but you can also evidence to prospective purchasers any issues with covenants, restrictions, rights of way, and things like that over the property. And this just then improves the quality of your viewings, and it helps to reduce fall-throughs, as well as helping to deliver the best customer journey. Some transactions may involve the sale or purchase of property via a company, for example, when selling commercial property, new builds, or a letting portfolio. In such cases, you are required to identify the beneficial owners of the business and carry out customer due diligence. A beneficial owner is anyone who has 25% or more of the shares or voting rights. As these stats show, land held by corporate and commercial bodies is not insignificant, and establishing beneficial ownership information can present challenges. As discussed, there is within the 5th Money Laundering Directive the intention to provide greater transparency of ownership. Now, the 5th Money Laundering Directive is due to be released next year. Now, at the moment, there are a couple of ways to establish ownership information. The 4th Money Laundering Directive, which is the one we're obviously operating under currently, introduced the Persons of Significant Control Register, and this is available via Companies House. However, some of this data is still incomplete, and where subsidiaries hold over 25% of the shares, more investigation is needed. So we're just going to have a quick look at an example of how to establish beneficial owners. So a beneficial owner is an individual who has a 25% or more controlling stake in the business. Now be aware, you may have more than one beneficial owner. In some more complicated corporate structures, the beneficial owner or owners may be identified through holding companies, depending on the ownership status of the company you're acting on behalf of. So in this example here, an agent is instructed by company Y to sell a portfolio of properties. Now, looking at the ownership structure, we can see that Mr. A owns 25% of company Y. Mr. B also owns 25%. Mr. C owns 30%, so he also owns 60% of C&D Limited, which in turn owns 50% of company Y. And then Mr. D only owns 20% of the company Y. So where we have anyone with 25% or more of the shares, we need to apply customer due diligence. So in this case, we need to apply it to Mr. A, Mr. B, and Mr. C. Types of customers that may indicate lower risk for simplified due diligence include a public authority or publicly owned body in the UK, A financial institution that itself is subject to anti-money laundering supervision in the UK or equivalent regulation in another country. A company whose securities are listed on a regulated market. Beneficial owners of pooled accounts held by a notary or independent legal professional, provided information on the identity of the beneficial owners is available upon request. A European community institution, or a pension scheme that doesn't allow assignment of interest. The reality is, in a lot of cases, that this is going to be difficult to obtain and even more difficult to conduct customer due diligence. So let's take the example of a sale of a repossession property by a bank. In such cases, you may, provided you've outlined it in your anti-money laundering policy and your risk assessment, apply simplified due diligence. Banks are themselves regulated entities under the anti-money laundering regime and will therefore have their own risk policies and procedures in place. Unless anything else in the transaction arouses suspicion, you could apply simplified due diligence. This will involve obtaining evidence of their existence from Companies House, for example, and retaining records of your correspondence, such as any emails or letters. And the same could be applied if you're dealing with a listed house builder. Landmark provide a range of electronic solutions to help estate agents demonstrate compliance with the money laundering regulations. Under the Compliance in a Box brand, we provide interpreted electronic AML checks to help agents verify their customers in under 60 seconds. From one online portal, we also enable agents to identify beneficial owners with direct access to the land registry title information and company checks, which outline the ownership status of the business. As discussed, dealing with foreign nationals and those not resident in the UK presents a challenge to agents and can be a more manual process. Our electronic foreign national checks can help you to fulfill your enhanced due diligence. Once you've established the initial checks on your foreign client, you can use the foreign national check to electronically verify the documentation you've been provided that it's not fraudulent. Using electronic data is more thorough than using paper methodologies and provides a better experience for your staff and your clients. Instead of requesting paper ID from purchasers and potentially slowing the transaction, how much more positive an experience are you providing your client with a quick electronic check? Yes, there's a cost associated with some of these, but what is the sunken cost to your business of staff spending time chasing answers to this information and storing it? And what is the perception this leaves your customers of your business? The cost of an electronic check compared to the potential listing you could win by redeploying staff time as well to think about to more proactive business activities. This service is pay as you go, no contracts, setup fees or tie-ins. Thank you very much for your attention, and I hope you have found this useful. If you do have any queries or indeed are interested in finding out more about Landmark and how we can help, then please do not hesitate to get in touch. My details are here on the slide. Thank you very much, everybody, and I hope you all have a great day.